There are three funding mechanisms available to applicants: grants, corporate loans, and project loans. Applicants are able to apply for a grant, a loan, or a combination of the two. Grants will either be under Section 31 of the Local Government Act, which are given as a single payment once fully approved, or as non-Section 31 grants, which are dispersed at pre-agreed times based on meeting specific project milestones. The maximum term for both loan types will be the life of the project concession minus 2 years, up to a maximum of 25 years. Loans will be at below market interest rates, and repayments will be every 6 months. More about loans can be found on page 22 of the application guidance document. In addition, project loans also include a connection delay feature, which means that in the event an anchor load customer fails to connect to a network for reasons beyond the project operator's control, impacting cash flow, the borrower may request a repayment grace period of up to a maximum of 3 years. The terms of the corporate loan and the project loan will be more favourable than those generally available in the market. Interest rates may be subject to change over time, but at launch, the corporate loan rate is just 0.25% per annum, and the project loan interest rate is 4% per annum. Interest rates are explained more in the application guidance on page 23. The type of funding given and whether or not it is allocated is determined by the HNIP Investment Committee, who will convene on a quarterly basis at the end of each of the funding rounds. There are two important things to note regarding the Investment Committee. Firstly, even if a project scores highly, there is no guarantee of funding being awarded by the HNIP Investment Committee. Secondly, the committee reserves the right to offer an alternative funding mechanism to successful applicants. For example, where an applicant applies for a grant, a loan may be offered, or where an applicant applies for a loan, a grant may be offered. Such a decision would only be made if the alternate funding mechanism would serve to increase the impact of the scheme or its value for money.